A few years ago, making $100,000 a year felt like the finish line for a lot of people. It sounded safe. It sounded successful. It sounded like the kind of income where money problems were supposed to become smaller, life was supposed to feel easier, and the future was supposed to look more secure. But today, that same number does not carry the same weight it used to. The cost of living has moved fast. Housing, groceries, transportation, insurance, and everyday expenses have changed the meaning of what a good income actually feels like. In the past, $100,000 might have been the top tier. Now, for many people, it feels more like the middle bracket. That is why financial strategy cannot be one size fits all. Someone making $50,000 a year should not be playing the same game as someone making $150,000 or $200,000 a year. The problems are different. The opportunities are different. The mistakes are different. And if you use the wrong strategy for your income level, you can work hard, earn more, and still feel like you are not moving forward. So in this video, we are going to break this down into three income levels: $50,000 a year, $100,000 a year, and the higher earning range of $150,000 to $200,000 and above. At $50,000 a year, the game is defense. It is about protecting every dollar, building a foundation, staying away from debt traps, and making sure one unexpected bill does not destroy your progress. At $100,000 a year, the game becomes automation and optimization. You need systems that move money before you can spend it, accounts that create tax advantages, and a clear number that tells you when you are financially independent. And once you reach $150,000, $200,000 or more, the game becomes tax efficiency, diversification, capital preservation, and the power of compounding. The real goal is not just to make more money. The real goal is to know what to do with the money once it arrives, because income alone does not make someone wealthy. The strategy behind that income is what decides whether that money disappears every month or quietly builds a future for you. When we talk about making $50,000 a year, the first thing to understand is that this is not a level where you can afford to be careless with money. It does not mean you are doomed. It does not mean you cannot build wealth, but it does mean that your margin for error is much smaller. At this income level, your take-home pay is roughly around $3,400 a month, depending on your state. That $3,400 has to cover rent, transportation, groceries, utilities, insurance, your phone bill, and hopefully some savings. So the strategy here is not about trying to look rich. It is about sequence. It is about knowing which dollar goes where first. The first priority is to destroy high-interest debt. And today, that does not only mean credit card debt. It also includes buy now, pay later debt. Credit card debt is already dangerous enough. The average credit card balance in America is over $6,000, and with current interest rates, that can cost someone more than $100 a month in interest alone. For a person bringing home about $3,400 a month, that $100 is not small. That $100 can be the difference between building savings and barely surviving until the next paycheck. And the scary part is that buy now, pay later services can feel harmless at first. Companies like Klarna, Affirm, and Afterpay promise that you can buy something now and pay it off in 4 easy payments. It sounds simple. It sounds painless. It sounds like there is no interest, so it must not be a real problem. But if you stack 3 or 4 of those purchases together, suddenly you have hundreds of dollars of future income already committed before the month even starts. And that is exactly what debt is. It is tomorrow's paycheck being spent before you even receive it. So if you are at the $50,000 level, this is where the defense begins. Write down every high-interest debt you owe. Write down every buy now, pay later payment that is still waiting for you. Look at the full picture, not just the monthly payment. Then start attacking it before you move deeper into investing. Because when income is tight, financial progress is not always about chasing the highest return first. Sometimes the smartest move is stopping the leak. Once high-interest debt is under control, the next priority is getting your full employer 401k match if you have access to one. This is one of the few places in personal finance where the math is almost impossible to ignore. If your employer matches 4% of your salary on a $50,000 income, that is $2,000 a year in completely free money. In a way, that is a 100% return on your contribution. There is almost no investment, no debt payoff strategy, and no shortcut that can guarantee that kind of return. Some people may choose to get the employer match even before paying off debt because mathematically it can be more optimal. But from a behavioral standpoint, it can also make sense to clean up high-interest debt first, especially if that debt is creating stress and keeping you stuck. The main point is this: once the debt is handled, do not leave the employer match on the table. The third priority is your emergency fund. Long term, the goal is still to have 3 to 6 months of expenses saved. But at the $50,000 income level, especially if money is tight or debt has been part of the picture, that goal can feel too far away at first. So a more realistic first target is 1 month of expenses. If your monthly take-home pay is around $3,400, then aim to save around $3,400 in a high-yield savings account. Even 1 month of breathing room can change everything. When a car repair shows up or a medical bill appears, it does not have to go straight onto a credit card. It becomes a problem you can handle instead of a crisis that pushes you backward. The fourth priority is the Roth IRA. At this income level, the Roth IRA is extremely powerful because you are likely in a lower tax bracket. That means you pay taxes on your income now, contribute to the Roth IRA, and then your investments can grow tax-free. In 2026, the Roth IRA contribution limit is $7,500 a year if you are under the age of 50. For someone earning $50,000, maxing that out may be difficult because it is about 15% of gross income. But you do not have to start by maxing it out. Even $200 a month invested into a Roth IRA starting at age 25 could grow to more than $700,000 by retirement, based on historical market returns. The fifth priority is understanding what your time is worth. If you make $50,000 a year and divide that by about 2,000 working hours, your time is roughly worth $25 an hour. That number matters because it helps you judge how to spend your energy. If you are going to do a side hustle, it should probably earn at least that much, if not more. But the highest return move is usually not spending every weekend driving for DoorDash or Uber. The better move may be getting a certification, learning a skill, or earning a credential that can permanently raise your income from $50,000 to $55,000, $60,000 or more. Because the goal at the $50,000 level is not to stay at $50,000 forever. This level should be a stepping stone. The habits you build here, paying off debt, capturing the 401k match, saving for emergencies, investing through a Roth IRA, and valuing your time properly, are the habits that make higher income much more powerful later. So if you are at this income level right now, which one of these priorities would change your life the fastest? Is it getting rid of debt, building that first month of savings, or finding a way to increase your income permanently? Now let's move into the $100,000 income level, because this number has changed a lot. For a long time, making six figures sounded like a major financial finish line. It sounded like the kind of income where you had finally made it. But today, $100,000 does not mean what it used to mean. It is still a real achievement, and if you are earning that much, you should absolutely recognize the work it took to get there. Not everyone reaches this level, but the truth is, the cost of life has moved so quickly that $100,000 now feels different. The median household income in America is around $84,000. That means a $100,000 salary is only slightly above the median household income, not dramatically above it. Back in 2016, the median household income was closer to $59,000. So earning $100,000 back then meant you were much farther ahead of the middle. It felt more powerful. It created more space. Today, $100,000 can still solve a lot of survival problems. You can probably cover rent, you can buy groceries, you can pay your bills, you may have some discretionary income, and if you are reasonable, you can spend without tracking every single dollar, and nothing catastrophic happens immediately. That is the big difference between $50,000 and $100,000. At $50,000, a small overspending mistake can be painful right away. At $100,000, you may not feel those mistakes as quickly. You might overspend and still be okay for the month. You might eat out more, upgrade your apartment, lease a nicer car, or let lifestyle creep quietly enter your life. And because the pain is delayed, it can be harder to notice the damage. That is why the $100,000 level is not just about earning more. It is about creating systems before comfort turns into carelessness. At this income level, your survival problems are mostly handled. So the question becomes different. The question is no longer, can I make it through this month? The question becomes, how do I use this income to build freedom? At the $100,000 income level, the first big move is to automate your savings before you ever see the money. This is where reverse budgeting becomes powerful. Instead of waiting until the end of the month to see what is left, you decide what your future gets first. If your monthly income is around $6,000 and you want to save $600, that $600 should be moved before anything else happens. Then the remaining $5,400 becomes the money you use for rent, food, bills, transportation, and everything else. The key is not willpower. The key is automation. If the money lands in your checking account and sits there, it is easy to spend it. But if it automatically moves into an IRA, a backdoor Roth, a high-yield savings account, or a brokerage account, then you are not relying on motivation. You are building a system that works quietly in the background. A strong target is a 15% savings rate. So if you are bringing home about $6,000 a month, that means aiming for around $900 in savings. If that feels too high right now, start with 10%. If you can save and invest 15% of your take-home pay, around $900 a month in this example, that becomes $10,800 per year. And if you start doing that at age 30 and continue until age 65, that can still grow to more than $2 million based on historical market returns. The second big move is to consider an HSA, which stands for Health Savings Account. An HSA is one of the most tax-efficient savings vehicles because it has triple tax benefits. First, your contributions are tax-deductible, which can lower the amount of income tax you pay in that year. Second, the money inside the account can grow tax-free. Third, withdrawals for qualified medical expenses can also come out tax-free. You must be enrolled in a high-deductible health plan to use an HSA, but these plans are common enough that many people may have access to one. In 2026, the HSA contribution limit is around $4,400 for individuals and $8,150 for families. The strategy is simple but powerful. You contribute to the HSA, invest the money inside the account, then pay your medical bills out of pocket with regular money and save the receipts. At first, that may sound strange. Why would you open an HSA and then not use it right away for medical bills? The reason is that there is no time limit on reimbursing yourself. If you contribute $4,000 into an HSA, invest it, and let it compound at 8% for 30 years, that $4,000 could become about $4,250. Meanwhile, if you pay your medical expenses out of pocket and save receipts for $1,700, $2,000, and $3,000, you now have $6,500 of qualified expenses that you never reimbursed. 30 years later, you can use those receipts and pull $6,500 out of the HSA completely tax-free. The rest of the money can stay in the account for future medical costs, and after age 65, the account can also start to function more like a traditional IRA. The third big move at the $100,000 income level is to know your number. At $50,000, the question is often, am I going to be okay this month? But at $100,000, the question becomes, when am I done? When can I become financially independent? The number is easy to calculate. Take how much you spend in 1 year and multiply it by 25. That is another way of using the 4% rule. If you spend $60,000 a year, your financial independence number is $60,000 times 25, which equals about $1.5 million. Once you know that number, your financial life becomes clearer. You can work backward. You can see how much you need to save. You can test what happens if you lower your annual expenses by $1,000 or $2,000. You can see what changes if you raise your income by $5,000, $10,000, or $15,000. And this is one of the most important truths in personal finance. Your retirement timeline depends heavily on your savings rate, not just your income. If you save 20% of your income, retirement may take roughly 37 working years. If you save 30%, that can drop to about 28 years. If you save 50%, it can drop to around 17 years. Now let's move into the final bracket, the $150,000 to $200,000 and up income level. At this point, the financial game changes again. When you are earning this much, your largest expense is usually no longer food, transportation, or even rent. For many high earners, the biggest expense becomes taxes, That is why the strategy at this level has to become more sophisticated. You are not just trying to save money anymore. You are trying to protect the money you already earn. You are trying to reduce unnecessary tax drag. You are trying to preserve capital while still allowing your wealth to compound over time. At this income range, your marginal tax bracket may be around 24% to 35%, and in many cases, it can sit above 30%. So every dollar you can legally shelter, defer, or place into a more tax-efficient account has a bigger impact. The more you can reduce taxes today, the more money you keep invested, and the more powerful compounding becomes in the future. The first major move here is the backdoor Roth IRA. If you make more than $150,000 per year, you may start running into limits with direct Roth IRA contributions. For a single filer, once income reaches around $153,000, you can no longer make the full Roth IRA contribution. Once income passes around $168,000, you may not be able to contribute directly to a Roth IRA at all. That is where the backdoor Roth IRA comes in. The process works in two steps. First, you contribute money to a traditional IRA because there is no income limit for making that contribution. The important detail is that you do not invest the money first. Then, inside your brokerage account, you convert that money into a Roth IRA. When done correctly, this gives high earners a way to still get money into a Roth account, even when their income is too high for a direct contribution. But this can get complicated if you already have an existing traditional IRA with invested funds. That is where the pro rata rule can create tax issues. There is also another version called the Mega Backdoor Roth. This is usually available through certain employer retirement plans, especially at large companies like Google, Microsoft, Meta, and Amazon. First, you contribute the normal amount into your 401k. In 2026, that amount is $4,500. Then, if your employer plan allows it, you may be able to contribute additional after-tax money into the plan. In the Amazon example, that could be another $42,500 into an after-tax account. Then you do an in-plan conversion into a Roth. That means someone with access to this strategy could contribute up to $67,000 of their own money per year into these accounts. And this is where the difference between earning money and building wealth becomes very clear. At this level, it is not just about how much you make. It is about how much you keep, how much you protect from taxes, and how much you allow to compound for decades. So if you are a high earner, are you actually using the tax tools available to you? Or are you simply earning more and letting taxes quietly take a larger share every year? Once you are in the $150,000 to $200,000 and up income range, tax strategy matters, but it is not the only thing that matters. You also need to think about how your money's invested, how concentrated your wealth has become, and whether the income you work so hard to earn is actually being protected. The second major move at this income level is diversifying your portfolio. A common high earner playbook suggests that younger investors, especially those under 50, can hold a heavy allocation in equities, sometimes around 80 to 100%, with a smaller allocation of around 5 to 10% in alternatives like precious metals or crypto if they are comfortable with that risk. The logic is simple. When you are younger, your biggest advantage is time. You have time to recover from market drops. You have time to keep buying through volatility. You have time for compounding to do the heavy lifting. So at that stage, the focus is usually wealth creation. But as you get older, the strategy has to shift. After 50, it can make sense to reduce equity exposure to something closer to 70% or 60%, depending on your situation, because now capital preservation becomes more important. You are not only trying to grow the money anymore, you are trying to protect what you already built. International ETFs can also be part of that diversification, especially when you want exposure beyond the United States. That becomes even more important if part of your income comes from RSUs. RSUs stand for restricted stock units, and they are a major reason many people reach the $150,000 to $200,000 income range, especially in tech or public companies. RSUs can be an incredible benefit because they give you stock in the company and can reward you for staying there longer. But RSUs also come with a major risk that many people underestimate. When RSUs vest, they are taxed as ordinary income, whether you sell the shares or not. That means the IRS treats them like cash salary. For example, if 100 shares vest when your company stock is trading at $200 per share, that creates $20,000 of W-2 income. You owe tax on that value even if you never sell the stock. So the move is to have a strategy before the shares vest. For many people, the default strategy is to sell RSUs as they vest and move that money into a diversified portfolio. That may feel emotionally difficult if you believe in your company, but it can be the safer choice. Because if you hold the RSUs and the stock price goes up, you may owe capital gains when you eventually sell, on top of the tax you already owed when the shares vested. And if the stock price drops, you may be left holding a concentrated position in the same company that also pays your salary. If more than one-third of your total investments are tied up in your company's RSUs, you may be taking on more concentration risk than you realize. The final move at this income level is thinking seriously about what your tax bracket will be in retirement. For many people earning $150,000 to $200,000 or more, the tax bracket they are in today may be much higher than the tax bracket they will be in after they stop working. If your current marginal tax rate is between 24 and 35%, but you expect your retirement tax rate to be lower, then traditional 401k contributions become very powerful. Maxing out a traditional 401k at $24,500 can save roughly $8,000 to $9,500 in taxes this year, depending on your marginal tax rate. That is not a small benefit. That is money you keep working for you instead of sending it away immediately. And later, if you withdraw the money in retirement at a lower tax rate, you may win on both ends. That is why a strong combination for high earners can be a pre-tax 401k plus a backdoor Roth IRA. The traditional 401k helps reduce taxable income today, while the Roth side gives you tax-free money in retirement if the rules are followed. And that is the bigger lesson across all income levels. At $50,000, the focus is defense. You need to kill high-interest debt, grab the 401k match, build a starter emergency fund, use the Roth IRA when possible, and increase the value of your time. At $100,000, the focus is automation and optimization. You need to save before you spend. Use accounts like the HSA if you qualify, and calculate the financial independence number that tells you where the finish line is. At $150,000 to $200,000 and beyond, the focus becomes tax efficiency, diversification, and capital preservation. Because money does not come with automatic wisdom. Making more money can help, but it does not protect you from bad systems, lifestyle creep, tax drag, or concentration risk. Every income level has its own trap, and every income level has its own opportunity. The question is not just how much do you make. The real question is whether your strategy matches the income you have right now. If it does, then every raise, every bonus, every investment, and every financial decision can start working together. And that is when income stops being something that simply passes through your hands and starts becoming something that builds freedom.